Welcome to today's video with Sherman, my CPA coach, walking you through what's changing with taxes in 2026 and what that could mean for you and your family. The latest adjustments from the Big Beautiful Build Act, combined with inflation updates from the Internal Revenue Service, will bring several important updates that Sherman is going to walk us through. Let's dive in.
Massive tax changes are coming in 2026 as a result of Trump's big beautiful bill. And if you do not know them before you file your taxes, you may very well end up overpaying. The IRS has just released new guidelines for several things like the new tips deduction, the new overtime deduction, the increased standard deduction, the improved itemized deduction, all on top of there being new retirement contribution limits, HSA limits, and so much more. These things are changing so fast that even your tax professional may not know about these rules when tax season rolls around. It is going to be an absolute mess. So as an actual practicing CPA that has been updating you on every major change in the tax code, I want to quickly walk you through the major updates that you need to know before you file your taxes. So let's go ahead and jump in. Okay, so everyone watching this is going to have to decide between taking the new standard deduction when they file versus taking the new itemized deduction. And there have been some major changes to both of these, so let's carefully walk through this. Now, if you do not know, a tax deduction simply lowers the income that you report on your tax return. If you have $10 in income, $7 in deductions, you will only pay tax on the remaining $3 of income. So more tax deductions mean less taxable income reported on your return and less taxes that you will pay on that income. So we want more tax deductions. Now, starting in 2026, the standard deduction will be a little over $16,000 for single taxpayers, about $24,000 for head of households, and a little over $32,000 for married filers. Plus, seniors over the age of 65 will be able to take an additional $2,000 to $3,000 senior deduction, plus a new $6,000 bonus deduction for each eligible senior over the age of 65 with adjusted incomes below $150,000 if filing jointly with a spouse, or $75,000 if they are filing single. And this can be applied to your 2025 tax returns when you file them. So if you are a senior or have a parent or family member that is, make sure that you or they don't miss out on this deduction. This is free money on the table. Now, moving on, we also have a new charitable tax deduction. Before these changes, you could only deduct your charitable donations if you took the itemized deduction on your return, which most people actually do not take. However, now, even if you do not itemize, you can deduct up to $1,000 of your charitable donations if you file as a single taxpayer, or up to $2,000 if you file jointly with a spouse. And if you are donating much more than this, then you may want to take a look at taking the new itemized deduction instead of the standard deduction. So let's talk about that. Starting in 2026, the itemized deduction will allow you to deduct charitable donations that exceed 0.5% of your adjusted income, which is a new rule. It will also allow you to deduct your state and local taxes up to $40,000 now if you have less than $500K in income, which is also new and huge for people who are living in high tax states or counties. Plus, you can add any medical and dental expenses you have that exceed 7.5% of your income. Plus, of course, any mortgage interest you may have for qualified mortgage debt and any casualty or theft losses you may have. So if you want to pay the least amount of taxes possible, go ahead and tally up all of your itemized expenses here to see if those amounts altogether will exceed your standard deduction. If it does, the itemized deduction will likely be more beneficial for you. But there's far more new deductions that you need to be aware of in advance in addition to this, like the new tips and overtime deductions, for example. So let's start with tips. In short, if you report qualified tip income, you can now claim a tax deduction against that tip income up to $25,000 if you earn less than $150,000 of income as a single filer or less than $300,000 as a joint filer. Now, this deduction can even be claimed by self-employed individuals who receive tips that are not classified as a specialized service business, which are generally professional service businesses like doctors, lawyers, accountants, and businesses that rely on the expertise or skill of one or more individuals. But other than that, self-employed individuals can claim this deduction if they work in an occupation where they customarily and regularly receive tip income. Either way, whether you are an employee or business owner, if you are eligible for this, you will want to make sure you don't miss this deduction, as it can literally save you thousands of dollars in taxes when you file. And the same applies to the new overtime deduction. Individuals who receive qualified overtime compensation may deduct their overtime pay that exceeds their regular rate of pay up to $12,500 if they are filing single and report less than $150,000 of income, or up to $25,000 if they are filing married with a spouse and report less than $300,000. Now, there is some nuance with this overtime deduction, honestly, because technically it only applies to the overtime premium that is paid on your wages. Usually, overtime is paid at time and a half, meaning you get paid your standard hourly rate plus half of that hourly rate each hour. So in very simple terms, if you make $10 an hour, you would make $15 an hour in overtime wages likely. And with that, the new deduction would only apply to that extra half portion. So in that example, up to $5 of your wage would be eligible for this deduction per hour anyway. Still, if you work a lot of overtime, this deduction can still save you a significant amount of money. Now let's talk about the new retirement contribution limits starting in 2026, which the IRS also just released. So if you do not know, using retirement plans like IRAs or 401ks grant you tax benefits in the form of either A, tax-deferred income, or B, tax-free investment growth. Traditional retirement plans are typically used to defer income, while Roth retirement plans are typically used for tax-free investment growth. Most people choose an account structure that best suits them based on their income and tax bracket. That said, starting in 2026, individuals with earned income will be able to put up to $7,500 into their IRA or $8,600 if they are over the age of 50. And employees with 401ks will be able to put up to $24,500 of their wages into their 401ks or $32,500 if they are over the age of 50. Plus, individuals between the ages of 60 and 63 will be able to put up to nearly $36,000 into their 401ks as an employee starting in 2026. Then employers who sponsor these plans will be able to put up to another $47,000 or so into these plans depending on the plan design, which if you're self-employed may allow you to get anywhere from $72,000 to $83,000 into your own 401k account in one given year, again, depending on your plan design. Now, I already have a separate video that discusses these limits and these tax benefits in greater detail, so just comment retirement if you would like to learn more about this. But we can't talk about the new retirement limits without mentioning one of my favorite tax advantage accounts, HSAs, or health savings accounts. Now, if you follow this channel, then you already know why we love using HSAs, because it is one of the only tax advantage accounts that grants you a tax deduction for putting money into it while allowing your proceeds in that account to grow tax-free when invested, and also allowing you to withdraw those funds tax-free when you use it for qualifying expenses at a later date. And starting in 2026, individuals will be able to put up to $4,400 into their own HSAs if they have a self-coverage high deductible plan, or $8,750 if they have a family plan that is considered to be a high deductible plan. Plus, individuals over the age of 55 will be able to make an additional $1,000 contribution to their HSA, or $2,000 if they are married and both individuals are over the age of 55.
Wow, that was a lot of information. That was good information.
Yeah, yes, it was. And I have a question. So for the new tip deductions, you can deduct all tips.
You can only deduct what they call qualified tips. And qualified tips mean that you're tipping voluntarily. It's not mandatory that you leave an 18% or 20% tip. You're tipping because you want to tip. So as long as it's a voluntary tip, then it's considered a qualified tip.
And for new overtime deductions, I can deduct my overtime.
You can deduct the amount that exceeds your hourly amount. And I think Sherman gave a very simple example, which was really good. That if you make $10 an hour and you work past your 40-hour work week, then that means that that $10 becomes time and a half, which is $15. So the $5 that exceeds that $10 hourly rate is the amount that you're able to deduct as overtime.
Mm, I get it now.
Okay.
Yeah, that's good.
Well, Lerone, I'd like to say in closing that anyone that has questions, don't stress. Just hit the link in the description and shoot them over to Sherman. He's the go to guy and he'll get you straight.
All
Thank you
right.
for tuning in.
Talk
Have
to
a
you
good
later.
evening. Bye, Lerone.
Bye bye.